January 2nd, 2026. What I'm about to explain is not speculation, not a forecast, and not a theory about what might happen. This is already happening. The switch has been flipped. As of midnight Beijing time on January 1st, China's silver export restrictions officially went live, and in just 48 hours, the global silver market has begun to fracture in real time. If you watched my earlier analysis, you knew this moment was coming, but even then, the speed and intensity of what followed have shocked nearly everyone involved. This wasn't a calm adjustment period. It was chaos. Industrial buyers moved into panic mode. Retail investors rushed for exposure. Behind closed doors, procurement teams, refiners, and institutions all reached the same realization: at once the silver market they thought they understood no longer exists. Today's breakdown is a Day 1 aftermath report. Not opinions, not exaggeration, but a clear account of what happened when China enforced the ban, how markets reacted, how prices moved, and why the next phase may be far more dangerous than most people expect. At the center of this crisis is a fact long ignored. China controls roughly 60 to 70% of global refined silver supply. When the dominant supplier restricts exports overnight, the result isn't a mildly tighter market. It's a supply shock. And supply shocks don't reveal themselves first through headlines or charts. They appear through fear, hesitation, and the sudden realization that paper contracts don't keep factories running. Physical metal does. In the hours after the ban took effect, volatility surged and confidence cracked. Price screens told one story, but the real damage was unfolding beneath the surface where physical silver availability was evaporating. This chapter sets the foundation, because once you understand what has structurally changed, everything that follows becomes inevitable. If this matters to you, stay with me. Subscribe so you don't miss what comes next, and comment 1 if you're focused on physical silver, or 2 if you're watching this purely as a trader. To understand why the reaction was so violent, you need to understand what the ban actually means in practice, not in headlines. At midnight on January 1st, 2026, China's Ministry of Commerce formally implemented the new silver export licensing system. This was not a warning shot. It was policy enforcement. Overnight, the rules of the global silver trade changed, and most of the market was unprepared for how restrictive the framework truly is. Only 44 companies have been approved to export silver for 2026 and 2027. 44. Before this policy, hundreds of Chinese firms were active exporters, supplying refiners, industrial users, and bullion dealers across the West. The new requirements effectively eliminate small and mid-sized exporters entirely. To qualify, a company must demonstrate annual production capacity of at least 80 tons of silver, maintain a proven export record from 2022 through 2024, secure a minimum $30 million credit line, and obtain direct state approval and licensing. Miss one requirement, and you're out. This is not a temporary bottleneck. This is structural exclusion. The companies that historically supplied Western electronics manufacturers, solar producers, automotive suppliers, and bullion dealers are no longer legally allowed to export. They didn't slow down shipments. They stopped. When a country controlling the majority of refined silver supply removes most exporters from the system overnight, the impact is immediate and brutal. Supply chains don't have redundancy built in for this kind of shock. Contracts are written assuming continuity. Inventories are managed on just-in-time delivery models. There is no buffer for a sudden disappearance of supply from the world's dominant source. This is why the market reaction wasn't gradual. It was instant. Buyers realized within hours that this wasn't about price negotiation anymore. It was about access. And once access becomes uncertain, price becomes secondary. The first 48 hours weren't about speculation. They were about survival positioning. This is the foundation of everything that follows, because once exporters vanish, the stress moves downstream, and that stress is already showing up in prices, premiums, and behavior across the entire market. The first place the stress surfaced was price, but not in the way most people expected. In the days leading up to the ban, silver was trading in a relatively controlled range as markets attempted to price in the risk. On December 30th and 31st, silver hovered around $75 to $78 per ounce. Volatility was elevated, but the structure still looked familiar. Traders believed the impact would be gradual. they were wrong. When Asian markets opened on January 1st, the reaction was immediate and violent. Silver surged to $84 per ounce within hours, printing a new all-time high. This was not algorithmic momentum or a slow repricing. It was panic buying. Large players rushed for exposure at the same time overwhelming liquidity. For a brief window, the market revealed what happens when fear collides with thin supply. Then came the pullback. Profit-taking accelerated technical selling kicked in, and headlines about geopolitical developments temporarily cooled safe haven demand. By the end of the session, silver had retraced toward the mid-70s. To the untrained eye, it looked like a rejection. In reality, it was a controlled retreat. The market had just absorbed a historic shock and didn't collapse. By January 2nd, silver was swinging violently between $73 and $76, posting intraday moves of 3 to 5% within hours. This level of volatility isn't normal. It signals stress. But focusing only on spot price misses the real story. The screen price reflects paper contracts. It does not reflect availability. The real signal is what happened simultaneously in the physical market. While paper prices pulled back, the cost to actually obtain silver began to explode. This divergence is critical. When spot stalls but premiums rise, it means supply is breaking underneath the surface. That is exactly what the market is telling us now. Price didn't fail. It revealed the fault lines, and those fault lines lead directly into the physical market, where the disconnect between paper and reality has become impossible to ignore. If you want to understand what's really happening, stop looking at the spot price and start watching the premiums. Spot is the paper reference. Premiums are the truth. And since the ban went live, premiums across the physical silver market have exploded in a way that leaves no room for denial. In Shanghai, physical silver was trading roughly $8 to $10 per ounce above the COMEX spot price before the ban. That was already elevated. Within 48 hours of the restriction taking effect, reports showed premiums jumping to $12 to $15 above spot, with some desperate buyers paying even more. When silver shows $75 on a screen but costs close to $90 to actually acquire in the world's largest metals hub, the message is unmistakable. Physical supply is breaking. The same pattern is spreading globally. In the United States, American Silver Eagle coins that normally carry a $3 to $5 premium are now listing at $8 to $12 over spot at major dealers. Generic rounds that once sold the $2 or $3 over spot are now $6 to $8 higher if they're available at all. 100-ounce bars, when found, are commanding premiums of 10 to 15% above spot. Many dealers aren't even quoting prices, they're quoting delivery times. Europe is no different. Dealers in the UK and across the EU are reporting doubled or tripled premiums, widespread out-of-stock notices, and delivery timelines stretching from days into weeks. India, already a major silver consumer due to industrial demand and cultural use, is bidding aggressively as Chinese exports dry up, pushing premiums to record levels. This is what a real shortage looks like. Paper markets can pretend supply exists. Physical markets cannot. Premiums rise because metal is scarce, not because of sentiment. When buyers are willing to pay far above spot just to secure delivery, the paper price becomes irrelevant. And while retail investors are just beginning to feel this pressure, something far more serious is unfolding behind closed doors among industrial users. That's where the real panic has begun. While retail investors are noticing higher premiums and empty shelves, the real crisis is unfolding quietly inside boardrooms and procurement offices. Industrial users don't have the luxury of waiting for prices to stabilize. Silver isn't an investment for them, it's a required input. And since the ban took effect, many of these companies have been pushed into emergency mode. Electronics manufacturers were among the first to feel the impact. One major producer in Southeast Asia reported being notified that first quarter 2026 silver deliveries would be delayed by 4 to 6 weeks at minimum. In a just-in-time production environment, that's catastrophic. Assembly lines don't pause gracefully, they shut down. A delay of this magnitude doesn't squeeze margins, it threatens output. Solar manufacturers are facing an even harsher reality. Silver paste is essential for photovoltaic production, and European producers have been informed by Chinese suppliers that no new contracts will be accepted for first quarter delivery. Existing agreements may be honored, but future supply is uncertain. Some suppliers aren't even willing to quote prices because they don't know if they can source material at all. That level of uncertainty is unprecedented. Medical device companies are reporting similar disruptions. Silver is used in wound care, antimicrobial coatings, and specialized equipment. Suppliers are invoking force majeure clauses unable to guarantee pricing or delivery timelines. In the automotive and EV sector, the pressure is intensifying rapidly. Each electric vehicle requires significant silver content across power electronics and control systems. With global EV production scaling, demand is relentless. Reports indicate that some EV component manufacturers in Europe and North America are securing silver at $85 to $90 per ounce equivalent for guaranteed delivery. These are not speculators chasing upside. These are manufacturers paying whatever it takes to avoid production shutdowns. When industrial users abandon price sensitivity, the market has crossed a critical threshold. And this is why a single comment from late December suddenly carries far more weight than it did at the time. On December 27, 2025, just days before the ban took effect, Elon Musk responded publicly to the news with a short but telling statement. "This is not good. Silver is needed in many industrial processes. At the time, many dismissed it as a casual remark or exaggeration. 48 hours into the ban, it now reads like an understatement. Musk's companies rely heavily on silver. Tesla uses it in every vehicle it produces, from electrical contacts to power management systems. SpaceX depends on silver for high-performance aerospace and communication applications. When someone with direct exposure to industrial supply chains signals concern, it is worth paying attention. And Musk is far from alone. CEOs, CFOs, and procurement officers across multiple sectors are now confronting the same problem at the same time. Supply certainty has vanished. This is where the market behavior becomes especially revealing. Institutional investors and banks entities that usually favor liquidity and paper exposure have begun quietly converting paper positions into allocated physical silver. Exchange-traded funds that were once considered convenient proxies are now being treated as risk layers. When institutions demand delivery, instead of rolling contracts, it signals a loss of confidence in the paper system's ability to perform under stress. At the same time, banks and large industrial users are building private inventories, not for profit, but for survival. This is strategic stockpiling, the kind that occurs when participants believe supply may become unavailable at any price. This behavior accelerates shortages because every ounce removed from circulation tightens the system further. What we are witnessing is a shift in price discovery itself. For decades, futures markets dictated silver's price and physical markets followed. That relationship is now reversing. Physical markets are starting to lead and paper prices are struggling to keep up. Once delivery cost becomes the true benchmark, traditional exchanges lose control. And that loss of control becomes especially dangerous when you examine the exchange at the center of the paper market itself. The pressure point in this crisis is the COMEX, where silver futures underpin global paper pricing. On the surface, trading continues as normal. Contracts change hands, liquidity appears intact, and settlement mechanisms remain in place. But beneath that surface, the structure is under severe strain. As of January 1st, 2026, registered silver inventory on the COMEX stands at roughly 127 million ounces. This is the metal actually available for delivery. Against that, open interest represents more than 1.1 billion ounces of paper silver. In simple terms, for every ounce of deliverable metal, there are nearly 9 paper claims. That ratio only works when most participants never ask for physical delivery. That assumption is now failing. In early December, nearly 48 million ounces were demanded for delivery in just a few trading days, draining more than a third of registered inventory. That was before China's ban even took effect. Now, the incentive to stand for delivery is far stronger. Physical premiums are rising and arbitrage opportunities are widening. When paper silver trades near $75, but physical metal can be sold far higher elsewhere, pressure on the exchange becomes relentless. This is how paper systems break through arithmetic, not emotion. London is showing similar stress. Vault inventories have declined sharply, and lease rates have surged, signaling extreme difficulty sourcing metal for immediate delivery. High lease rates are not noise. They are a warning. The paper market depends on confidence. Once that confidence erodes, stability disappears quickly. As the paper market strains, another bottleneck is tightening the system, even further refining. Switzerland plays a critical role in the global silver supply chain, producing much of the high-purity metal required for industrial use. Refineries there convert raw silver into the precise forms demanded by electronics, medical, and energy manufacturers. When refining slows, supply does not just tighten, it freezes. In late December, Swiss refiners began implementing stricter export review protocols. Compliance checks increased, documentation requirements expanded, and shipment approvals slowed. After China's ban went live, these delays intensified. Refiners are now prioritizing long-term contract holders and strategic clients, while spot buyers face extended wait times or outright refusals. This creates a dangerous illusion. Raw silver may still exist in the system, but if it cannot be refined and delivered to specification, it is functionally unavailable. Industrial users do not need silver someday. They need it now in exact form at exact purity. Any disruption in refining turns a supply issue into a production crisis. At the same time, this shortage is accelerating a broader geopolitical shift. China's silver ban is not an isolated move. It fits a clear pattern of resource control seen over the past decade. Rare earths, antimony, tungsten, gallium, and germanium have all been subject to export restrictions. Silver is simply the latest addition to that list. In response, the United States designated silver as a critical mineral in late 2025. That acknowledgement confirms its strategic importance, but it does not create supply. Domestic production covers only a fraction of global demand, and new mines take years to develop. There is no short-term fix. As nations compete for limited material, this becomes more than a market issue. It becomes a strategic contest, and silver is now firmly on that chessboard. To understand why this crisis cannot resolve itself quickly, you have to look at the underlying supply and demand math. Global silver demand in 2025 reached approximately 1.24 billion ounces. Total supply, including mine production and recycling, was closer to 1.1 billion ounces. That leaves a structural deficit of more than 200 million ounces in a single year. This was not an anomaly. It was the fifth consecutive year of deficit. From 2021 through 2025, cumulative shortfalls consumed nearly an entire year's worth of global production. That missing silver did not vanish. It came from above ground, inventories, vault holdings, and strategic stockpiles built up over decades. Those reserves are now dangerously depleted. Industrial demand is the driving force. Solar energy alone consumes hundreds of millions of ounces annually. Electronics, electric vehicles, medical applications, and advanced manufacturing continue to grow regardless of price. Silver is not optional in these processes. It is essential. The problem is that supply cannot respond quickly to higher prices. Roughly 3/4 of silver is produced as a byproduct of copper, zinc, lead, and gold mining. Production decisions are driven by base metal economics, not silver prices. Even if silver doubles, output does not surge. Primary silver mines account for only a small portion of supply, and new projects take 8 to 12 years to bring online. Recycling offers little relief. Much industrial silver is embedded in products where recovery is difficult or uneconomical. Panels, electronics, and medical devices are not easily recycled at scale. The conclusion is unavoidable. There is no rapid solution. China's export ban did not create this deficit. It exposed it, and once a structural shortage becomes visible, markets do not revert quietly. 48 hours into China's silver export ban, one conclusion is unavoidable. This is no longer a theoretical risk. It is a live, structural reset. The silver market is being forced to confront a reality it postponed for years, where paper promises collide with physical limits. That collision has already begun. For decades, silver pricing relied on leverage and confidence that delivery would rarely be demanded. That confidence is fading. Industrial users are no longer price sensitive, they are supply sensitive. Institutions are no longer comfortable with exposure alone, they want metal. When availability becomes uncertain, price stops acting as a ceiling and starts acting as a signal. The critical question is not whether silver can reach $100, it is how the market gets there. An orderly path would mean sustained volatility, rising premiums, and gradual acceptance of higher prices. A disorderly path would involve delivery stress, forced settlements, and a breakdown in trust. Markets under this kind of strain rarely move quietly. The lesson here is strategic. Markets do not fail because prices rise. They fail when confidence disappears. Confidence in inventories, confidence in delivery, confidence in settlement. Once that trust erodes, capital moves defensively and fast. Ignore short-term swings. Volatility is noise. Structure is signal. Supply is constrained. Demand is inflexible, and time is not on the system's side. Understanding what you own and why you own it matters more now than ever. If this analysis helped clarify what's unfolding, subscribe so you stay ahead of the next developments. Share this with anyone who needs context and leave your thoughts in the comments. This story is far from over.